Hey everyone, welcome to today's Explainer. We're jumping straight into the absurdly lucrative, highly chaotic, and honestly, just fascinating world of modern retail investing. Look, if you've been watching the financial markets over the last few years, you've probably noticed a trend that completely defies logic. People who literally have no idea what they're doing are making absolute fortunes, while seasoned Wall Street veterans are just sitting there scratching their heads. So we're going to unpack the data today and figure out exactly how and why this is happening. All right, let's get right to it. The million-dollar question that's been driving traditional finance experts totally crazy. Why do the dumbest investors win? Now, this isn't a trick question, and it's definitely not a joke. It's a documented, hard reality of our recent market cycle. To really wrap our heads around the mechanics here, we need to ditch the fancy Wall Street jargon and look straight at the retail traders themselves. To get a feel for this phenomenon, we first need to meet a hypothetical retail investor. We're going to call him Dave. Dave has exactly 2 years of trading experience. Now, to put that into perspective, 2 years on Wall Street makes him the equivalent of a toddler who just discovered fire. But right now, Dave feels invincible. His portfolio is up 13% year to date. He just hit it big on some random crypto meme coin, and his confidence is absolutely off the charts. Dave's hobbies include watching The Wolf of Wall Street on repeat, pitching emerging biotech companies to girls at the bar, and of course, zinning. In his own mind, he's got what it takes to be a full-time trader. He is the ultimate market wizard. So, what happens next? Well, armed with all that overconfidence, Dave does what any completely irrational person would do. He calls his broker, lies about his net worth, and gets approved for options trading. Fast forward 3 months, and Dave is leveraged to the absolute max on out-of-the-money Tesla calls. His entire strategy, buy high and sell higher. His risk management, prayer. Meanwhile, his wife is just trying to figure out why 13 grand is suddenly missing from their savings account. Fast forward another 3 months, the Federal Reserve decides to hike interest rates, the market shifts, and boom. Dave's portfolio is down 67%, and his wife's new favorite hobby is Googling how to divorce a man who calls himself a market wizard. Now, Dave is actually the perfect example of a psychological phenomenon you might know, the Dunning-Kruger effect. But in this context, it acts like the financial markets version of Darwinism. It perfectly explains why completely uninformed people think they're the next Warren Buffett, why the genuinely smart people actually second-guess themselves, and why Dave is absolutely convinced that shadowy market manipulation is the only reason his options expired worthless. The crazy thing is, since 2020, if you were sitting happily on the left side of this curve, right where Dave was, you actually would have significantly crushed the S&P 500. Ignorance wasn't just bliss, you guys, it was profitable. And this behavior creates a totally new paradigm for investing. Look, traditional investors look at things like strong fundamentals or fair valuations. They read balance sheets. But the retail investors who have massively outperformed the market lately, they're using entirely irrational strategies. I mean, they're happily buying companies trading at 650 times their earnings. They're blindly riding internet trends that make less sense than pineapple on pizza. And they are relentlessly pumping their own investments, their bags, to absolutely anyone with a pulse. Just consider this highly satirical, completely fabricated quote that perfectly nails the pure insanity of recent markets. Why buy Apple when you can buy Fartcoin? Okay, obviously the Oracle of Omaha never said that, but the sentiment, it's spot on for the era we're looking at. I mean, why invest in a fundamentally sound, world-changing tech giant when a literal joke cryptocurrency is giving you tenfold returns in a matter of weeks? Logic just totally left the building. To really grasp why this wild behavior actually got rewarded, we have to zoom out to the macro level. When you look at the broader picture, the underlying cause of all this insanity is incredibly clear. We've been living through the greatest bull market in history. Over the last 17 years, the market has generated a staggering 715% return. That number is just massive. Essentially, the S&P 500 has been on an absolute unstoppable bender since 2009. Because of this massive, continuous upward trajectory, pretty much anything you threw your money at would have given you a positive return. The rising tide literally lifted all boats, even the ones with giant holes in the hull. And because the market was just going straight up, these highly irrational, risky strategies ended up overperforming and generating incredible alpha. But here's the hard truth about financial markets. Like all great benders, this one eventually has to end. Now, it hasn't fully collapsed yet, but the hangover is always looming out there. So how do investors prepare for it? The data gives us two main options. Option 1 is to sit on cash, just like Warren Buffett has been doing lately, but to a retail trader that is incredibly boring, and you're definitely not compounding wealth at the basic risk-free rate. So that brings us to option 2. Continue going all in, ignore the warning signs, and then aggressively blame others when the market finally reverses. Retail investors almost always choose option 2. They'll blame Jerome Powell, they'll blame politicians like Donald Trump, or invisible market makers. They have to blame somebody else, because taking losses on the chin just isn't how their version of investing works.
Which brings us to the actual mechanical secret behind our central question. Why do the dumbest investors win? Well, it isn't magic, and it's not just blind luck all the time. The answer is super simple once you look at the data. Retail investors absolutely love volatile, high beta stocks. They are drawn to them like moths to a flame.
Let's get just a tiny bit technical for a second and define what beta actually is, because this is the magic multiplier retail investors unknowingly rely on for those massive returns. Beta is simply a measure of a specific stock's volatility compared to the overall market. Basically, it tells you how much a stock is expected to swing up or down relative to a broader index, like the S&P 500.
So let's look at how beta works in practice. Take a real-world example, like Amazon. Let's say Amazon has a beta of 1.33. What this essentially means is that Amazon is 33% more volatile than the overall market. So if the broader market goes up by a moderate 2%, Amazon is expected to go up by 2.66%. But it works in the exact opposite direction too. If the market falls 2%, Amazon is expected to fall 2.66%. It's literally a volatility multiplier.
So why does this metric matter so much for our friend Dave? Well, because when the overall market is constantly going up, like it has been for most of the last 17 years, a high beta portfolio will mathematically crush the broader market. In a bull market, a high beta portfolio makes you feel like the next George Soros, confidently booking a celebration table at Nobu. But when the market turns down, gravity hits hard. In a bear market, that exact same portfolio turns you into the next tragic trending post on Wall Street Bets, desperately checking to see if the local payway is hiring. It's a tale as old as time in the finance world. The exact strategy that makes you rich on the way up wipes you completely out on the way down. So the next time your friend comes up to you at a bar, loudly bragging about their massive 10-bagger returns on some totally useless meme coin, just keep this fundamental truth in mind. Everyone is a genius in a bull market. A rising tide covers up a whole lot of bad decisions. As we wrap up today's explainer, I want to leave you with a final thought to help evaluate your own investment strategies before financial gravity finally kicks in. We know that 17-year market benders always end. History basically guarantees it. So ask yourself, when the music finally stops, will your portfolio be eating at Nobu, or will it be asking if payway is hiring? Thanks so much for learning with us today, and stay sharp out there.